Hello, and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for our two-day Metals and Mining Conference. Our next presentation is from Axcap Ventures. Please note you may submit questions for the presenter in the box to the left of the slides, and you can view a company's availability for one-on-one meetings by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Blake McLaughlin. He's the Chief Executive Officer of Axcap Ventures, which trades on OTCID under the symbol GARLF and on the CSE under the symbol AXCP. Welcome, Blake.
Thanks, John. Thanks for having me. And thanks for the opportunity to present at Axcap. We have some forward-looking statements in the presentation about projections and assumptions of future markets that are certainly no guarantee and everyone should consider. And we'll get onward. So about a year ago, we started the company Axcap with the consideration that capital markets were broken effectively for juniors. The stat that really hit home was that 65 out of 2,600 public mining companies listed in Canada had daily trading volumes over $100,000 in Q1 of 2024. It really illustrated the lack of liquidity and challenges in the investment community. We compounded that with the juniors problem, where over the last decade, we've moved from over $8 billion in actively managed funds in the resource space to about $1.5 billion today. And it's really compounded the challenge where it's created a fundamental buy-side challenge that has been expressed in some really, really tough valuations for great projects and great companies. So we came up with a strategy where we wanted to take advantage of these orphaned and undervalued assets that existed in the ecosystem, aggressively acquire some high-quality projects that we believe lack liquidity and the right market approach to really show their value. As such, we acquired 3 assets over the last year, which we'll discuss in more detail. And then we'll look to formulate an exit upside where we've been able to acquire these projects for less than $5 an ounce, drilled off in the ground with modern compliant resources, where we see our peers trading more in the $40 average per range in the early stage developers. And that is certainly the upside that we're looking to attain. So how do we plan to create value? Well, I mentioned the first step is attractive acquisitions. So we're looking for projects with substantial upside, but that have had big exploration expenditures on them in the past, where we can buy these projects for 5 cents per ounce drilled off. And typically that results in somewhere in the cents on the dollar or 10 cents on the dollar in terms of what's been spent historically on these projects. Really, then the goal is to get them into a condition where they're ready, de-risked, and clean, and ready for the inevitable free cash flow that the majors are producing to come downstream. Now, really, where the big value lies here is in our flagship. This is the 5th largest asset in the lower 40, or largest gold asset in the lower 48, 10th largest gold asset in the U.S. As a company, we trade at $4.10 per ounce, and our peers are trading at nearly 50 on average. This is the only 6+ million ounce deposit that is currently owned not by a $100+ million market cap company, and the only one that is not owned by a major in Nevada. We really see an opportunity for a re-rate here, and the macro setup hasn't been better for that. So, on that, the supply side has been falling short. For the last decade plus, we've seen relatively flat exploration expenditures, and that's resulted in a pretty sharp decline in terms of global gold discoveries. So we're not finding these 5+ million ounce deposits at a rate that we have, and that's creating a big value disconnect on what's already been discovered. The other side of that is that we're seeing the majors cashed up, at record levels, with continued margin expansion, and gold continuing to touch record highs. These majors are printing record free cash flows. There's at least 6 operators in the state of Nevada that have more than $500 million of cash on their books. while we're also seeing these companies sitting at record lows for reserves and resources and production levels that haven't been touched since 2018. So the supply side is set up exactly the way that it needs to be as well. So that comes to the asset snapshot. We're focused on Canada and the US only. Our position on gold and the future of gold gains comes from the strength of these two markets, and it's where we want to create stability in the portfolio. These projects all have substantial resources and have had substantial drilling and exploration done on them in the past, and we want to make sure that that value is recognized. So within the portfolio of 3 projects combined, there's 7.9 million ounces, 6.2 measured and indicated, and 1.7 million ounces inferred. These are large-scale projects. They're projects that have district-scale footprints and substantial upside to grow. We believe all of these projects have the potential to see near 5 million ounces or larger. When we talk about the management team behind the whole deal, we really have a team with a strong track record. Over $1 billion of capital raised, over 20 million ounces of gold discovered. Technical and capital market veterans that know how to build and evolve companies, and experience in companies that have taken juniors from single-digit million market caps to more than billion-dollar market caps. This experience is invaluable, and as the company rapidly evolves, we will certainly leverage this experience to continue growing in a strategic and a creative method. So early on, when we started the deal a year ago, before gold had really ripped, and we're in the market that we're in today, we saw value in gold inventory. We looked to companies and assets like Nova Gold and Seabridge, where they had substantial gold inventories, the prospects of building these assets where it was, long-term future, but the market caps showed substantial value still. And that was our underlying thesis, that buying and holding gold ounces in the ground had value and will continue to have value, particularly with discoveries dramatically decreasing. That evolved really quickly as the gold market evolved over the last year to 18 months. When we were buying these projects, the developer space really didn't have a substantial bid, and so advancing a project into a PEA was not necessarily the best way to create value. We feel that that's potentially changed over the last year, and so our model is always actively growing, but we continue to look for accretive M&A transactions as well as organic growth through our drill programs on our own assets that we currently own. The drilling's a big part of the model. Directors and myself have worked at projects that have really been brought to light and shown their true value through substantial drilling. Value creation through the drill bit is something we often talk about. And we feel Detour is one of the best examples, where in 2008, it was a low-grade historic gold mine that was shuttered. A lot of people didn't believe in this story at all. Nearly 1 million meters of drilling later, this deposit is one of the largest gold producers in Canada, and one of Agnico Eagle's centerpiece assets. And so it really goes to show that, through long-term views, substantial capital investment, real value can be created in the space. Another example that was close to me, I was here very early days as a junior geologist, but a sub $10 million market cap company that saw 1.5 million meters of drilling through really, really effective capital raises and realized a $2.2 billion cash sales in the asset after really creating substantial value through the drill bit. And so, again, really underpins our thesis that buy cheap, revalue these assets based on the good work that has been done in the past, and then apply really sound theories to continue to build value through drilling. And so that flips us into our asset portfolio, where we get into a little bit more detail in terms of why these assets are worth what they're worth, and where we really see the value and where we continue to drive catalysts from this portfolio. So our flagship, Converse in Nevada, is in the Battle Mountain Trend. The trend has done 50 million ounces of gold production historically. It's constantly ranked one of the top mining jurisdictions globally. And this permit is and this project is permitted for exploration, has no known impediments for open pit operations. It's effectively as turnkey as you can get. Sits adjacent to the highway with power and road infrastructure into the asset already. There's significant resource upside for future exploration and through the changing economics that the current metals market have shown us. So outside of the existing block model, there is substantial upside. And this resource was run at $2,000 gold, so at quite a conservative gold price relative to today's market. As I mentioned, top tier jurisdiction. We sit about 8 miles to the west of SSR's active Marigold mine. Marigold operates with proven and probable reserves at about 0.47 grams per ton, which is 10 to 15% lower grade than our average resource. About 8 miles to the north of us is I-80's Lone Tree Complex, which is the centerpiece of their processing infrastructure in the state. Both of these projects have done nearly 5 million ounces of production. Marigold's been operating for nearly 35 years, and they really show the type of ore bodies that are potential in this district, in this area particularly, along with the availability of workforce, supplies, materials, and everything that would be required to continue to advance this asset. Now we get into the nuts and bolts of why it's so big and why that matters. This resource has a measured and indicated resource of 5.6 million ounces. These are the high quality components of the resource. It means it's very well drilled out. When we look at this in terms of today's dollars, we estimate that it would take about $60 million US to replicate the drilling, let alone make the discovery. That value has been spent, and we have the data and the material that was produced during those programs. So we can continue to validate this and maintain a modern and compliant resource. There's advanced metallurgical work done for the project as well. This is a heap leach project, shows very good column test recoveries across all 3 redox states, 77 for oxide, 62 for transition, and 52 for the sulfides. We have a redox breakdown here. 1.25 million ounces of this is an oxide target near surface. I mentioned we look for projects with big leverage to the gold price. This is a good example of this as well. When we look at this resource and the sensitivity, we can run a $3,000 gold cone and put almost 8.2 million ounces in it. You continue to open availability to low-grade mineralization as the gold price continues to rise, and it shows that there's long-term blue sky potential for this asset, and what we believe is a path to 10 million ounces. So as I mentioned, the resource is certainly open to depth. We're just wrapping up a 5-hole drill program to show that. Really, in the current resource, all of the drilling is taken out. It was drilled off in a $1,200 gold environment, and as such, really is constrained by drilling and not in terms of geology or mineralization. So we drilled 5 deep holes through the bottom of this resource and outside of what has been tested. And this is where we see near-term catalysts coming for the company. We've encountered zones of mineralization greater than 1,000 feet and continue to show that there is a strong silver component to the resource with nearly 40 million ounces of silver that we will look to add to the resource as we progress the project. As part of this drilling campaign, we've recently released our first drill hole, and very much in line with our plan to show that there's substantial room to discover left outside of this resource and that there is a path towards 10 million ounces. And so right down the fairway, we drilled 21.2 meters at 0.3 within the pit, which was exactly as expected, and also showed that there was a new zone developing outside of the pit. So we drilled 26.2 meters of 2.5 grams per ton, which included 10.8 meters of 5.5 grams per ton, about 200 meters outside of the current pit constrained resource. These are potentially underground mineable thicknesses and grades, and really show that even very, very close to the existing resource, there's still substantial upside left at this deposit, and what we really intend to show. Part of this program also was to really test the roots of the system. So we drilled a very deep hole, twice as deep as anything that had been drilled historically, with the model that you target the favorable rocks in Nevada. The lithology, the rocks really mean something. And we know that we have these limestone formations that project underneath our deposit. These formations have created world-class deposits in Nevada. Deposits like Fortitude, which did 1.5 million ounces of 9 grams per ton historically. And so we're testing and showing that there is very, very high potential for exciting high-grade discoveries at depth, along with the bulk tonnage open pit resource that currently exists. And then what does it all mean? And so, we have Axcap here. We trade at about $4.10 EV per ounce currently, with 75% of our resources in Nevada. We look to recent M&A transactions in the state within the last 5 years to benchmark a path to create value. Typically, I look at the Orla acquisition of Gold Standard Ventures as a great benchmark, where a company that didn't operate in Nevada came in to the state because they wanted a presence in one of the best mining jurisdictions globally. They paid $63 an ounce for the asset. And this project was more advanced and had a pre-feasibility study on it when it was acquired. So it really gives us a great path to advance Converse towards a method of value creation for an asset that really has very, very similar attributes and provides a great framework for that. Some of the other advantages of this asset that have been underlooked historically, it's talked about as being a low-grade deposit, but grade is so critical in its relationship to strip ratio. So we like to show this. Converse sits right in the middle of the pack when you talk strip-weighted grade. Better than Railroad, Relief Canyon, and Marigold in this metric, and really is one of the real advantages of this project, where we really believe will show value. So I mentioned near-term catalysts of drill results over the next 3 months, and then slightly longer term, we expect, and we're guiding a PEA for the asset in Q4 of 2025. This was completed in 2012 at $1,200 gold, and the economics on the project like this have totally changed in that 10-year period. And we really want to bring that back to market and show people what they're missing in terms of the scale and potential viability of this asset. So cap structure, we're rolling out through a larger founders round escrow schedule currently, about 300 million shares outstanding, 250 million warrants for about 570 million shares fully diluted. The details in terms of warrant strike price are generally in the 20 and 30 cent range and are detailed in the investor deck. Along with our flagship Converse, we also have 2 other large-scale gold assets in Canada and the US. These are assets that have substantial exploration potential, but are a little bit less advanced than Converse. And with the way that the market has evolved, our focus has really been on Converse, but we're certainly looking to advance and build value within the rest of our portfolio as well. When we acquired Rattlesnake Hills, there was no resource, but there was 100,000 meters of drilling and $40 million of historic spend on the asset. We put a maiden resource together of 1.04 million ounces, 60% indicated. Really indicates the potential of the project here. Big drill intersections, 236 meters, 1.9 grams per ton, show a very robust mineralized system. This deposit looks very analogous to Cripple Creek in Colorado. It's really the driving mechanism behind exploration approach here. You can see there's a very, very strong analog, and that close tie has brought in several major producers to look at the asset. So the type of system produces these 10+ million ounce scale deposits. These alkalic intrusive gold systems are known globally to be significant for gold production. And the signature, chemically detailed geologically, has attracted companies like Agnico, Crest Evolution, and other majors to come in and test theories. There's still about 10 drill-ready, undrilled targets on the asset that have never seen a drill bit. And we're in the midst of permitting these so that it's drill-ready as we look to advance these assets once Converse is moving forward. The third project in our portfolio is our first Canadian asset. It's called the Newton Gold Deposit. It's about 150 kilometers south of Artemis Gold's Blackwater Silver Project, which just came online recently in British Columbia. This project has big, fantastic bulk tonnage intersections, nearly 700 meters of half a gram, 615 meters of half a gram per ton. These big tonnage intersections are what drive these big bulk tonnage deposits, and we certainly have them. Right now, it sits at about 840,000 ounces of gold with substantial upside to grow. the gold in soils anomaly that exists is 4 to 5 times the scale of the resource on the surface footprint. And this has really been confirmed with historic drilling over a 1.5-kilometer trend. Really, we see this as a drill-ready project that we can come in and advance systematically. And that is really our intention here over the next 18 to 24 months. The analogs to Blackwater are quite compelling. In terms of geology, they're very, very similar aged intrusions that have similar deposition structures. And certainly targeting growth will use similar mechanisms to how Artemis advanced their asset. So that leaves us here to some general question and answers. And I've put up info@axcap.ventures here.ca to get a hold of me or our team. So as I answer through these questions, we'll start with the first question. Are you actively managing, operating these projects, or largely financial investors? So we're both. Really, we started out as an investment vehicle looking to buy cheap ounces in Canada and the US. And we've seen a lot of value in how we can advance these projects ourselves and use our ability to raise funds to advance them. So we have a very small team, very small high-level technical team that oversees basically consultants as we work on these projects. But we did put this $3 million US drill program into Converse ourselves, managed by our team. And so really, we're using our abilities and our technical expertise to leverage that and show the upside. The next question, how are you financing your asset acquisitions? So last year as a company, we raised about $20 million. And really that's what we've used to get these 3 projects together and put this drill money into the ground. It's why and where our cap structure has gotten to today. And we're sitting at about $4 million in cash and prepaid commitments on the book currently. The next question is, are you acquiring 100% of these assets? And the answer is yes. Generally, our approach is we want 100% control of the assets. Part of this comes to the underlying model that there's value in the ground of these gold ounces. We want to make sure we have control over them and we can control the path that they go down. And also that as we acquire projects, that we understand, wholly what the carrying costs are and how we can manage that. And it's part of the reason why we haven't acquired any brownfield projects to date. But yes, in short, we're acquiring 100% of these assets as we move through the acquisitions. Another question that I see here, what are your milestones over the next 12 months, and are you capitalizing to support these? So I mentioned near-term milestones are a 3-month time frame. We expect to have the remainder of drill results come from our drill program. Within the next month, we expect the second hole from the program, which is a deep hole targeting these lower formations, and that'll be ongoing through the rest of the summer and early fall. Really, where we see a big catalyst happening is when we put out our PEA. We just released that we've engaged the consultants to complete that. Most of the technical legwork is already done, and we're guiding early Q4 for that. So those are the 2 real big near-term catalysts. And then really we see substantial opportunity to continue to re-rate this by de-risking it. The current administration in the US is very pro building mines domestically, and we see that as an opportunity. So we're going to look to the fast track program and whether we can advance the permitting on this asset, really into something that secures it as a development asset over the next 2 to 3 years. We had a question on the timeline of the drill campaign. May have already touched on this. So the drill campaign started in March and had been ongoing until we just wrapped it up this week. Last hole, we're demobilizing everything currently. Everyone is drilling currently, and the labs are quite busy. And so we expect results to continue to roll in here over the next, let's say, 4 to 12 weeks is our nearest estimate to get all of the results in from the program. Okay, I think we've got through all the questions here, and I just want to remind everyone we have info@axcapventures.ca as the email to reach out to me directly or our team. Thank you everyone for attending, and please reach out with any questions or follow-up you may have.